Hello guys, welcome back to my YouTube channel. The last time on my previous video, I told you guys that anything that I have to do with Forex, anything that is going to help you in gaining more knowledge as long as trading is concerned, because I've gone into the trading, I've experienced a lot of theory on trading, so I can say that trading this market is very. It's just like studying, whereby there is no stop in learning, because as we keep on learning, new things keep coming up. The chart pattern we saw today, that's not the chart pattern we are going to see tomorrow or in the few months, years to come. So I told you guys on my previous video that as long forex trading is concerned, as long crypto trading is concerned, any news that is going to help us in trading, that is going to help us to shape our mindset on trading, that I'm going to be bringing them up to this video. So today I'm going to be bringing this video about the theory of supply and demand. So I will advise you to watch till the end of this video so that you're able to get more knowledge about trading supply and demand, because that's what I also trade. So with this little um, explanation, with this little knowledge, with this little video that's going to be coming up next, I believe it's going to shape up your mindset on how to trade supply and demand. So make sure you watch to the end of this video, and I promise you, you won't regret watching this video at the end. So stay to the end of this video.
If I told you that price goes up when there are more buyers than sellers, I'd be lying to you. In modern markets, that sentence is completely wrong, and believing it is exactly how smart money unloads their bags on retail. Today, I'm going to show you how price really moves using supply, demand, order books, and Wyckoff logic, in a way you'll never unsee again. Welcome back to the channel. In this video, you'll learn why more buyers than sellers is a praked myth, where real supply and demand actually live in the order book, who really moves price, how liquidity gaps create crazy spikes and crashes, and how Wyckoff's volume versus price logic lets you read the battle between big players and retail. By the end, you won't look at a chart as random candles anymore. You'll see a war between aggressive and passive money. Let's fix the biggest misconception first. People say, price went up today because there were more buyers than sellers. Sounds logical, right? But here's the problem. On any exchange, or every trade, there is one buyer and one seller. The quantity bought equals the quantity sold, always. So there cannot literally be more buyers than sellers in executed trades. What actually changes is this: who is more aggressive? Who is more patient, who hits the other side's orders. Price moves not because a magical extra buyer appeared, but because one side is attacking and the other side can't or won't absorb anymore. To really see supply and demand, you need to understand two types of orders. 1. Limit orders. Patient orders. I want to buy at this price or better. I want to sell at this price or better. These orders just sit there, waiting. They build the order book. 2. Market orders. Impatient orders. Fill me now, I don't care, just hit whatever is there. Here's the key idea. Limit orders. They are the real supply and demand. Limit buy. Resting demand. Limit sell. Resting supply. Market orders. They move price. They cross the spread, consume limit orders, and push price up or down. So in Wyckoff language, supply and demand live in the limit orders. Price movement comes from market orders hitting that supply and demand. Let's walk through what actually happens when price moves. Price moves up when market buy orders hit and consume, the sell limit orders at the ask. If buyers keep attacking, they eat through all sellers at that price. The next available sellers are higher. So price ticks up. And if you have short sellers with stop losses just above a level, when price tags those stops, they turn into market buy orders too. That's how you get short squeezes. Forced buying on top of real buying. Price moves down when? Market sell orders, hit and consume, buy limit orders at the bid. Once those bids are gone, the next buyers are lower. So price drops. Long traders' stop losses turn into market sells, creating liquidation cascades. So the summary is simple. Market buys lifting the offers, pushed up moves. Market sells hitting the bids equals down moves, not more buyers than sellers, just more aggressive buyers versus more aggressive sellers. Price doesn't only move because one side is strong. Sometimes it moves violently because the other side disappears. Imagine a supermarket. Today, water is $1 a bottle. Tomorrow, most suppliers vanish and shelves are almost empty. You don't need a huge rush of demand for price to go up. A few buyers are enough because there's a no supply curve. Markets behave the same way. If sellers pull their limit sell orders, the ask side becomes thin. Even small market buys can push price way up. If just buyers pull their bids, the bid side becomes thin. Modest selling can cause big drops. This is called a liquidity gap. Price jumps not because everyone is crazy bullish or bearish, but because there's no one on the other side. Wyckoff would call this no supply or no demand conditions, crucial in understanding where trends can extend or reverse. Now let's bring in Wyckoff's secret weapon, the relationship between volume and price. Think of it like this: volume equals effort, price movement equals result. You don't need to know who is buying or selling. You just compare effort versus result. Some key patterns. 1. High volume, small price movement, huge effort, tiny result. One side is attacking, but the other side is absorbing. Example: massive buying at resistance, but price barely breaks and closes weak. Strong sellers above, hidden at supply. 2. High volume, large movement, huge effort, huge result. Dominant side is winning, either a powerful breakout or a pure climax near the end of a move. Context decides if it's continuation or exhaustion. 3. Low volume, big move. Small effort, big result. The other side has vanished. That's your liquidity gap in action. Trend continuation or a manipulated move in a thin market. So every candle, every bar, you ask, given this effort and volume, is the result in price strong, weak, or suspicious? That's Wyckoff's reading of the battle. All these micromechanics, limit orders, market orders, liquidity, volume, they fit into Wyckoff's big picture. Chapter 1. Accumulation. Smart money quietly buying from weak hands in a range. You see big volume on down moves, but price doesn't make new lows. Absorption of supply. 2. Markup. Demand dominates. Pullbacks are shallow, down bars on lower volume. Breakouts actually follow through. 3. Distribution. Smart money selling to the public near the top. You see strong up bars on big volume, but then no follow through. That's supply overcoming demand. 4. Markdown. Supply dominates. Rallies are weak, up bars have low volume, then price falls again. Your job as a trader is not to predict the future perfectly. Your job is to read who is accumulating, who is distributing. Is the market in a phase of absorbing or dumping? Let's wrap this up with a quick checklist you can use every time you open a chart. Next time you look at price, 1. Forget more buyers than sellers. Instead ask, who is more aggressive right now? 2. Think in orders. Limit orders. Resting, supply and demand. Market orders, so actual price movers. 3. Watch liquidity. Thin order book. Small orders, big moves, deep book. Big orders, smaller moves. 4. Read effort versus result. Volume big, move small, absorption. Someone strong on the other side. Volume big, move big, dominance or climax. Volume small, move big, no opposition, liquidity gap. 5. Place yourself in the Wyckoff cycle. Are you in accumulation, markup, distribution, or markdown? Are you trading with smart money or providing exit liquidity prioritized for them? Once you start thinking this way, you'll stop chasing every green candle, and instead you'll see where big players are absorbing, where retail is trapped, and where the real opportunity is.
If this is your first time watching this video, you can click up the subscribe button. In as much I've said that before, so I just want to say it again as a reminder. Click up the subscribe button, like and share this video for more of forex trading and Bitcoin trading signal and more educational lecture like this to come. Peace out.